A review of the debt restructuring proposals submitted by the government of Sri Lanka on 28 June 2023, when Sri Lanka's original default of its external debts was announced on 12 April 2022, it was done hurriedly by a handful of persons without the prior approvals of the Monetary Board of the Central Bank of Sri Lanka, Cabinet, or Parliament. Whilst that high-handed and illegal action was highlighted on many occasions by numerous persons, no action has been taken by any authority to bring to book those who were responsible for that reckless action. The government's present action to follow a more transparent and open process to announce the restructuring of the local debt is therefore welcome, but unfortunately, there are many gaps, flaws, inconsistencies, and suspicious actions which have crept into the current process as well, which negates any benefit may have been derived from such limited transparency. At the time of the external debt default announcement on 12 April 2022, the CBSL Governor Nandalal Weerasinghe gave a categorical assurance that local debt would not be restructured. Whilst the governor made that assurance repeatedly, several ministers also confirmed that position. Several analysts contended that such a position would be untenable, both practically and technically. Nevertheless, the government and the CBSL continued in its denial, leading to many persons being lured to invest in the local T-bills and bonds on a continuous basis. The governor, Treasury Secretary, and the Monetary Board members would also have been aware of the imminent local debt restructuring, but they continued to actively encourage the EPF management, which reports to the Monetary Board, to invest the members' funds in the government securities, notwithstanding the risk of the imminent haircuts. Now that it has been confirmed that the EPF investments are to be restructured, it may have to be ascertained as to whether the above-mentioned officials had been in criminal breach of trust in relation to the handling of the investment decisions of the EPF. Since the first announcement of the debt standstill on 12 April 2022, 442 days had elapsed by 28 June 2023. During such period, many highly costly foreign tours by top Sri Lankan authorities to various parts of the world had been made ostensibly to deal with the debt crisis. Highly expensive debt restructuring consultants, Lazard Freres Says and legal consultants, Clifford Chance LLP, have been engaged. Numerous discussions with the IMF and other multilateral agencies have been held. But the Sri Lankan authorities have so far only been able to formulate a proposal which has not even had the acceptance of any of Sri Lanka's creditors, external or local. The current proposal also does not, in any way, assure that Sri Lankan will be placed on the envisaged debt sustainability path, and therefore it is very unlikely that it could serve as a credible plan to steer Sri Lanka out of the debt crisis that has presently engulfed the nation. A glaring omission in this highly superficial and amateurish debt restructuring proposal is that it has not even been subject to any sensitivity analysis, as is usually done in exercises of this nature. For example, this entire program could turn out to be a total disaster if the Sri Lankan rupee suffers even the expected 10 depreciation in the next few months. The plan will also crash if economic growth continues to be negative for a few more quarters. Such obvious vulnerabilities indicate the fragile nature of this restructuring plan, and any attempt to portray this incomplete and risky plan as a viable and realistic proposition borders on the effort being termed a deliberate deception thrust upon an unsuspecting public. On a preliminary evaluation, it is clear that the government's plan suffers from a series of deficiencies. Firstly, government has violated the principle of pari passu treatment of all creditors, as has been rightly and repeatedly assured by several responsible authorities in the past. Contrary to repeated assurances, some creditors have been favored significantly over others. T-bill investors are also treated quite differently from T-bond investors, even though both groups of investors have invested in the same government securities, with only the tenors of the instruments being different. Secondly, financial instruments, which are identical in nature, have been given different treatment based on the person holding the instrument at the given time, This asymmetrical treatment is a clear discrimination and reeks of arbitrariness, and leaves space for big-time corruption. It also violates the principle of assuring uniformity of the intrinsic integrity of identical financial instruments, which is vital to ensure order and consistency in the financial system. Thirdly, in the absence of any assurance that these proposals have been endorsed and/or accepted by the key groups of creditors, the proposals presented by the government on 28 June 2020, three seem to be a mere wish list of the government. In the coming weeks and months, these proposals are likely to be carefully reviewed by the many external and local creditors who have been affected by the debt default. At this stage, it may suffice to point out that the government has previously repeatedly assured that the debt restructuring burden would be shared amongst all creditors, foreign and domestic, in a fair and just manner. However, even on a preliminary assessment, it is now obvious that such assurance has been totally disregarded, and therefore the reneging of the government's solemn assurances may not be taken too kindly by the affected external and domestic stakeholders. In fact, even within the specific classes of local creditors, there seems to be proposals that may be considered as being inconsistent in relation to different creditors. Over the next few weeks and months, these government proposals are likely to lead to disagreements and further disputes between parties. Hence, the mistaken belief that these proposals are now ready to be implemented seems to be a canard that may have been spread by certain authorities and concerned parties. In particular, it would be noted that there is no confirmation that the current proposals, or, for that matter, even those debt restructuring proposals contained in the IMF reports, have been accepted by the bilateral creditors or external private creditors. In fact, it is well known among the financial circles that Sri Lanka's largest creditor, China, has sought priority status for its loans and advances to Sri Lanka, and have categorically ruled out any haircuts in relation to its loans and advances. This debt restructuring plan does not in any way address the vital need to systematically reduce the debt to GDP levels over a planned time horizon through the expansion and growth of the real economy. The authorities who presented this restructuring plan seem to have overlooked the fundamental fact that even in the case of a simple restructuring of a loan of an entrepreneur, the first question that the bank manager asks is as to what new or expanded sources of income the entrepreneur expects funds to flow into his business so as to be in a position to pay the restructured loans. In the same manner, the most vital need now is for Sri Lanka to grow and expand the real economy and build its GDP through some credible strategies over a finite time horizon in order to convince its creditors that the country is truly on a path to reach debt sustainability. However, that aspect is conspicuously absent in this plan, and only a theoretical number-crunching exercise seems to have been done on how to basically deprive Sri Lanka's creditors, including the EPF members, of their rightful and hard-earned dues. One of the main thrusts of the restructuring plan seems to be to claim that the balances of EPF members as at the end of 2022 will not in any way be affected or trimmed. However, available information shows that the interest income that has been credited to the members' account in the year 2022 has been a mere nines, which is far lower than the levels at which interest was paid on government securities during the year. In fact, T-bill and bond interest rates were well over 25 from about July 22 onwards and over 30s from about August 22 onwards, and were paid by the government to all investors, including the EPF. Hence, it is obvious that the income earned by the EPF should have been at least around 25 for the year 2022, which rightfully will belong to the EPF members. In that context, it will be noted that the Central Bank Provident Fund, in which CBSL Governor Nandalal Weerasinghe and Treasury Secretary, also a Deputy Governor of the CBSL Mahinda Siriwarden, our members, had credited a handsome interest of 29 to its members for the year 2022. On that basis, it is abundantly clear that the EPF members have been deprived of a huge earning of around 20 of their balance for the year 2022 via this major deception carried out by the EPF management, perhaps with the connivance of the government authorities. It will therefore be noted that the EPF members have been already subjected to a massive haircut, although it has been done in surreptitious and disguised manner in order to conceal the real and true position from the unsuspecting public. It is now clear that the government is attempting to take an undue and unethical advantage by treating the EPF members with scant disdain and disregard, perhaps because the EPF members do not possess a collective or organized voice, which will articulate the members' concerns to the relevant authorities. The government has been rightly cautious in meeting the aspirations of the banking institutions, which have a strong and powerful voice through their associations and chambers. However, the government has not been as sensitive to the needs and concerns of the EPF members, the majority of whom are ordinary and common citizens of the country. As is known now, the government is currently not settling any of its bilateral or private external debts. It would also be recollected that at the time the debt default was first announced, it was claimed by undertaking the default there would be sufficient forex freed or released for the purchase of essentials for people, since debt repayments would then not have to be made. However, the fallacy of that claim is now seen as most government hospitals lack consumables and medicine. Fuel consumption has been deliberately reduced to around 50 of the pre-default consumption levels via high prices. And construction material and other intermediate goods imports have decreased by over 50s due to suppressed demand. Sadly, however, even after all these reductions in consumption and activity, there is still inadequate forex available in the economy, leading to the acute contraction of the economy by over 10 per quarter. In that background, it is difficult, nay, impossible, to expect the government to have any forex resources left to even make modest payments towards external debt repayments, if and when loan repayments commence in a few months' time. It would therefore be obvious that these figures and data of intended repayments would be meaningless unless the real economy is stimulated so as to be able to improve the present sources as well as generate new streams of economic activities and forex earnings. Unfortunately, however, that vital aspect of any restructuring plan has been woefully overlooked by the authorities in the present instance. As is well known, China is Sri Lanka's biggest bilateral lender. However, the outcome of the discussions of the Sri Lankan authorities with the Chinese authorities is not even mentioned in the restructuring plan. That may be because China may have expressed its disagreement to these proposals. If that is the case, it would be difficult, nigh impossible, to even presume that an agreement could be reached in line with the parameters as set out by the government in this restructuring plan. The restructuring plan envisages the central bank's T-bill holdings being converted into T-bonds. This exercise, however, seems to be a simple window dressing, since no useful purpose would be served in reducing the government's debt levels, as it would not reduce the government's liabilities in any way. If at all, this exercise will only seriously damage the central bank's balance sheet by creating a serious mismatch of the central bank's assets and liabilities, leading to disastrous medium-term consequences for the entire country. Further, contrary to any perceived expectation that there would be a benefit from a reduction in the interest rate for the government, it would be noted that the entirety of the central bank's profit generated from the interest it receives from the government via its T-bill holdings would, in turn, be applied to pay dividends back to the government, and hence the transaction would have been cash, neutral as far as the government is concerned. As per the CBSL plan, out of the total T-bills issued of ERs, 4.1 trillion, 62.4 or 2560 billion is held by the CBSL of the balance, 5.5 or Rs 225 billion is held by others. In that others category, the recent foreign investments of around USD 600 million in government securities, including treasury bills, would also be included. It would be further noted that such investments in T-bills would be left untouched in the restructuring exercise, and in that regard, as to whether those investments by foreign investors were made, based on prior assurances by certain Sri Lankan authorities that their hot money would be free from any restructuring, may need to be further investigated. In addition, The continuation of the exemption of T-bills in the restructuring exercise would allow those hot money investors to continue to rake in massive returns in Forex, as already enjoyed by them since March 2023. At a time when ordinary Sri Lankan EPF members have been denied their rightful returns and the people are continuously urged to suffer the massive price increases and shortages, the government's action to reward the undisclosed hot money investors in such a handsome manner may need to be closely probed to ascertain whether any cozy relationship has been developed between any Sri Lankan authorities and hot money investors to achieve this result. An ISB investor, Hamilton Reserve Bank, had filed an action at a U.S. federal court against the Sri Lankan government to recover their investment in the Sri Lankan IS. Lately, Jeev trade unionist Mr. Wasantha Samarasinghe and 6 others have sought an order from the Supreme Court to stop any form of restructure of the investments held by the EPF in Sri Lankan government, T-bills and bonds. The impact of the court decisions in these cases would also be a crucial factor in the consideration of the intended debt restructuring process. The CBSL has rightly claimed that the banking sector has already borne a significant burden with their taxes increasing from 39 to 48, with their NPL with their NPLs also increasing significantly. As it is well known, one of the prime reasons for the NPL rise in banks was the arbitrary and massive increase of interest rates by the CBSL on 8 April 2022. Nevertheless, it is fair that the CBSL is now anxious that the banking sector be cushioned as much as possible to ensure the stability of the financial system. In the same manner, however, the general Sri Lankan public, including the EPF members, have also been affected badly with massive utility price increases, unprecedented interest rate escalations, imposition of heavy taxes, continued shortages of essential imports and medicines, sudden removal of welfare payments, etc. Therefore, on the same logic, the CBSL would surely concede that EPF members and the general public should also be spared the agony of suffering from the Monetary Board's cleverly disguised ruse of depressed interest rates on the EPF members' life savings by depriving them of the earned income that should have been rightly credited to their accounts. In this context, whilst it would be readily conceded that any disturbance to financial system stability could be costly and trigger multiple crises, as stated by the CBSL, it must be kept in mind that any disturbance to political and social stability would also be equally costly and could trigger multiple crises. In any event, it must be reiterated that the Sri Lankan authorities should have never defaulted on its debt as done on 12 April 2022, which has led to the current situation where serious economic and social consequences have to be suffered, while also having to restructure the debt. As is now known, MUM Ali Sabri was appointed as Finance Minister on Monday, 4th April 2022, and Dr. Nandalal Weerasinghe and Mahinda Siriwardene were appointed as the Central Bank Governor and Treasury Secretary, respectively, on Friday, 8th April 2022. Thereafter, on the very next working day, after the weekend of 9th and 10th April 2022 and a public holiday on 11th April 2022, the Central Bank Governor and Treasury Secretary had made the unauthorized, illegal, unilateral, and controversial debt standstill. That reckless debt default announcement has now led to catastrophic short-term and long-term repercussions to the economy, with the relegation of Sri Lanka to a status of a bankrupt nation since that day. Needless to say, if not for that reckless and suspicious announcement, the current pain, uncertainty, and shock being experienced by various stakeholders of the Sri Lankan economy would not have taken place.